welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, April 5th, 2023, and I'm pre-recording this Trading Places Live for tomorrow, Thursday, April 6th. Let's see, currently futures are pretty early in the evening, but right now we have futures on the Dow down 13, S&P 500 down 3.5, NASDAQ down 22, so it looks like the underperformance in the NASDAQ on Wednesday seems to be carrying over into after hours. We'll see if that continues tomorrow, but a lot can change overnight, so we'll see what happens there. Crude oil prices currently just down about 10 cents, still trading a little bit above $80 a barrel. The 10-year Treasury yield, which took a pretty big hit on Wednesday to the downside, closing at the lowest level in months, is rebounding just a tad. We're up about 2 basis points after hours, 3.31%. currently on the 10-year Treasury yield. Let's go through today's agenda. So we will start off with the daily market recap, talking technically, chart of the day. Then I want to get into just looking at some trades. So I'm going to give you trading strategies, something that we do at Earnings Beat. So I'll show you that. Then earnings spotlight and the 3 you must see. Let's go ahead and jump right into the daily market recap. So this was the action that we just saw today on Wednesday. The Dow Jones Industrial Average finished up 80 points, which was up about 0.25%. S&P 500 down 10, so that was down about 0.25%. NASDAQ, though, got hit harder on a relative basis, down 129 points, or roughly 1%, a little bit over 1%. Mid caps down 2/3%. Small caps down about 0.8%. So overall, mixed action, mostly down. The Dow Jones was lifted by a couple of key defensive groups. And as you look down below here at the sectors, utilities up about 2.6% on Wednesday. Healthcare up 1.7%. So pretty good action there. Unfortunately, the aggressive groups, which had been leading the market to the upside, took a hit. We saw discretionary stocks down a little bit more than 2%, industrials down 1.3%, and technology down a little bit more than 1.1%. So overall, pretty good action. We're holding above key moving averages. The AD lines, in my opinion, still look really strong, especially on the major indices. We saw the healthcare pick up. We've now gotten a breakout on healthcare. We can see utilities turning up. Even the groups that were weak on Wednesday, discretionary, industrials, technology, their AD lines have been pretty strong in 2023. So overall, it looks like the market's still being accumulated. As long as we trade above the 20-day moving average on the major indices, and you can see the NASDAQ actually trading with the 20-day above the 50. If we get that configuration across the board, that's what we're looking for. Still got a little bit of work to do on the Dow. The 20 is underneath that 50. But if you look at the S&P 500, that 20 is zeroing in on the 50. It's just a tad beneath 4,020 versus 4,027. So it's got a little bit more work to do, but that does appear like we are on the verge of making that golden cross there, which would be bullish for U.S. equities. The 10-year Treasury yield, that's what I was just referring to. Multi-month low. This is the lowest close on Wednesday that we have seen since all the way back in September. So we closed just under 3.29%. I guess there are a couple of rules of or schools of thought here. Number one, if you're bearish, you're thinking, oh, yields are going down because the economy's softening. We had the ADP employment report out this morning. It wasn't good. Came in below expectations. You might look at it from a bullish side and saying, hey, you know what? We still had growth. It was a little bit less than expected, which is kind of what the Fed wants to see. And these lower yields could be saying we've got additional or potential rate cuts coming down the road from the Fed. So it just depends on which side of the fence you're on, whether or not you look at this as bullish or bearish. When I look at the price action today, let's pull up the S&P and we'll go to an intraday chart. Yes, most indices, sectors, so forth were down today. But if you look at a 5-day chart, We actually, in the afternoon hours, we're coming back again. So that's been kind of the theme. If you go back to June of last year, or even into the fourth quarter of last year, we were seeing gap downs and early morning selling, but it was followed by afternoon buying, which is indicative of accumulation. So if you look, going back 5 days on the S&P, last couple hours of the day buying, last couple hours of the day buying, last couple of the days or hours of the day buying. Here we were kind of flat. That was on Tuesday. And then Wednesday, again, last couple hours were relatively flat. We did finish up a little bit, but you can see there was an afternoon rally. And so it's hard for me to get bearish in the market when we continue to see buying even after a little bit of downward movement in the morning. If we move on to talking technically, the S&P 500 here on the daily chart, we've seen a nice rally. We've seen price action move above the 20, move above the 50, and now we've got the 20 trying to move above the 50. TPO has crossed the center line. Momentum looks pretty good. We've got the RSI going through 60. It's pulled back a little bit now to 59, but overall going through 60. So the fact that that RSI has moved back up through 60 gives us a little bit more of a feel of an uptrend. And when you've got the PPO rising, the 20-day rising, trying to move through that 50, I think you play this as an uptrend until it's not. So I'd be looking, you've got a couple of recent tops on the S&P, one here, just a little over 4,000. You had one up here around 4,050. And then you've got both moving averages coming in between. So I think from a support standpoint, I'd watch the S&P 500 around 4,000 to 4,050. If we break down below it, I think short term, it turns a little bit more bearish. As long as it holds it, I'd be looking for the move up to test the February high. We've already seen the NASDAQ break above that February high. I wouldn't be surprised if the S&P 500 follows suit, but that's just something that I would be watching here in the near term. As we look at the NASDAQ, I think looks even more bullish, which is good. It's the more aggressive index. So the fact that we're seeing relative strength in the NASDAQ 100 so far in 2023, I think bodes well for stocks, at least until that changes. PPO did go slightly below the center line, but now it's coming right back up. We continue to see momentum build on the bullish side, which is good. You need to watch probably at about 12,800. That's an area where we struggled, put in a little cup here with the high resistance right at about that 12,800 level. Pulled back for maybe a week or so, and then we broke back out above that key cup resistance. So I think 12,800 here looks pretty good as support. If you want to go a little bit lower, again, look at that 20-day moving average, 12,709 right now. If both of those are lost, then you've got to kind of reevaluate, I think. Notice the RSI. RSI went all the way up to 70. Notice on the recent pullback when we saw the selling, it stayed above 40. 40 as your support on the RSI and 70 or above as your resistance on the RSI, that reeks of uptrend. And that's what we've seen so far throughout 2023, a beautiful uptrend on the NASDAQ 100. And as long as that remains in play, which again, I would watch the rising 20-day. I wouldn't worry about too much to the downside until that breaks. If that breaks, then we reevaluate. But until then, I think you've got to continue to have a short-term bullish mindset here. The August high is what I'm looking for on the NDX. A break above that, I believe, would be extremely bullish because that would reverse the long-term weekly chart that has a series of lower lows and lower highs. Take out that mid-August high, and that completely reverses that trend. So watch that level. And on the NASDAQ 100, currently that's at about the 13,700 to 13,750 level. All right, let's talk a little bit about the chart of the day. So what I wanted to show you today, a group that had not been performing really well or very well, has all of a sudden turned on the jets. Healthcare. I mean, look at healthcare from December through early March. This is while, you just looked at the NASDAQ chart. The NASDAQ's been in bull market mode. The S&P 500 has been moving up. So what's going on with healthcare? Why have we seen healthcare moving down for 3 consecutive months? I mean, we're talking about from above 140 down below 125. This is more than a 10% drop, while the overall market's been going higher. So healthcare was clearly an underperformer that you wanted to stay away from, but look at what's happened. All of a sudden, this group has caught fire and is now trending higher. AD lines broken out. PPOs turned positive. We're going to probably see a pullback at some point, but I would be looking down here at these 2 moving averages on any pullback as a possible entry point into the XLV or maybe into some of the individual healthcare names. Maybe to take this a step further, look at the relative strength of the XLV versus the S&P 500. Now, this is a this is a daily chart that goes back a year. But look at this downtrend that we saw on a relative basis in January. Remember when all that money was pouring into aggressive growth stocks in January? Well, it was rotating out of healthcare. Not every group can outperform the S&P 500, right? You get some that outperform for a period of time, and then others lag, and then it flips, and you rotate. It's actually a hallmark of a bull market. The fact that right now we're seeing some areas, some of the more growth-oriented areas, sell off a little bit the last couple of days. We're seeing that money rotate into some areas that were beaten down. That's not a bad thing. So really strong relative performance in healthcare to start the month of April. And we have broken out to a relative high that we haven't seen since back at the end of January. So just wanted to point it out. I think it's an interesting chart to watch to see whether or not it continues. But right now, healthcare is one of the hottest, if not the hottest sector here in the month of April so far. One thing I wanted to point out, because on Mondays, Wednesdays, and Fridays, we have a chart of the day, which is in our Earnings Beats Digest. And if you'd like to subscribe, it's free, no credit card required. If you go over to Earnings Beats and you scroll down, you'll see an area right here where you can sign up with your name, email address. Hit that subscribe button and you're set up. Again, that's free, no credit card required. You can unsubscribe at any time. I also want to point out that we have now opened registration for a big event that we're going to have on April 15th. So if you want to register, this is our bullseye forecast going into the balance of Q2 and throughout the rest of the year. Had a really good track record of forecasting the market on an annual basis since 2020. We've been doing the market vision events in the first week of January. So think of this event really as just like a mini market vision event, or maybe the sequel to the market vision event we had back in January. Earlier in January, I thought January would start off great, which it did. I thought we'd have a pullback heading into February, maybe into March. History tells us to expect that, and we did. And then I thought we would rally off of those lows, which we have. So what's going to happen the rest of this quarter? What's going to happen the rest of the year? Join me on April 15th, Saturday, 10 a.m., and I'll go over it. But all you have to do is click there to register. So you come in, sign up, and you can go down, scroll down, check out some of the things that we're going to be talking about. But it should be a really great event, and it's free to everybody. So sign up. Why not, right? Check it out. If you're bearish, I'm going to give you some things to think about on the bullish side. If you're bullish, hey, if there are things out there that I think are bearish, I'm going to point them out. And then I'll give you my forecast on where I think things are going to go. So make sure you mark your calendar. And most of all, go over to Earnings Beats and sign up. You do have to register for this event, but it's just a name and email address, nothing more, and no credit card required. So it'd be a great event, I think, for you to check out. All right, let's move on to trading strategies. So what I wanted to do here was I wanted to just go over the stocks that are on our strong AD chart list. Now, if you're a fan of the accumulation distribution line, which was created by Mark Chaikin, I've grown to really like this indicator over the years. And it's one of my go-tos as a secondary indicator, not as a primary indicator. I don't use the AD line to call the market, but I do use it as a confirmation signal for something I'm seeing. If I like a chart, maybe it's showing some good relative strength, and that AD line has been strong and rising, that just gives me further confidence that the stock's being accumulated, it's a leader, and when it pulls back, sometimes intraday, if you're a short-term trader, it can be a great trade in the afternoon. So what I try to do is I look for, the stocks that are on here. First of all, let me show you. I'll put this in edit form so you can see how many stocks. We have 406 stocks right now on this chart list. And the key here is, number one, they have a certain amount of relative strength. When we first create the list, the scooter score has to be over, usually I use maybe 70 or 75. So it's got to be a pretty high scooter score. And then it's got to have a strong AD line. And that's somewhat subjective. I look at the charts, I go through, and a lot of times I'm spending like 1 or 2 seconds on a chart. If that line's going up, straight up and consistently up, it's on the list. If it's a little choppy, I might take an extra second or two to kind of decide. It's a little bit more iffy. But normally if I'm on the fence, I usually include it. But if a stock, even if it has a scooter score of 98, if that AD line's going down, it doesn't get on this list. So the key to get added to this list is you need to have a strong AD line, but you also need to have some decent relative strength as well. So let's, if you think about it, you could pull up any of these charts. I'll go over a few more, but look at Apple. So Apple's AD line is just absolutely exploding. Notice the whole time it went down from August through the end of the year, AD line just went flat. Normally, if you're selling off and you're finishing down toward the lows of the day, which would indicate distribution throughout the day, your AD line would go down. In this case, it's going sideways. So what that tells me is that a lot of this move down in Apple over these 4.5 months were created by gap downs and early morning selling and followed up with afternoon buying. So the weak hands were selling in the morning, fearful, panicking out of Apple. And then the smart money was coming in and buying it when it was beaten up. That's what this tells me. Now, that doesn't mean that the stock's going to come rushing back. Remember, the AD line is a secondary indicator. So I wouldn't be buying Apple on the way down just because its AD line is staying up. I would wait. I'd want to see some sort of reversal. I'd want to see better technical action. Well, we started to see that at the beginning of the year. We went through the moving average. Eventually, we got the 20-day crossing over the 50. And look at the AD line breaking out. Now we're starting to show break of the downtrend line. We're trending above the moving averages, and the AD line's confirming it. So Apple, to me, if you have a down day, middle of the day, sometimes it's not a bad idea to think about buying Apple. You can keep a fairly tight stop. If it closes on its low, you get back out. But a lot of times it'll rally. That's how it gets a strong AD line. So, I'm just looking here over the last, I don't know, what is that, 7 days? You got 2 hammers where you came off of lows. Those send the AD line higher. So let's see what that looks like. This is a 5-day, 10-minute chart, but let's go 7 days. So we can see the 2 days where we had the big move down, followed by the recovery. Here it is. So here's Apple going down. Look at the final 2 hours. 156 to maybe 157.75. All of that in those last 2 hours. Now, some of you might say, well, that's nothing. It's a little over 1%. Well, there are plenty of you out there, I'm sure, making 1% or thereabouts in the matter of a couple hours on a stock like Apple. I think that's a pretty nice trade. But look at how it finishes. Finishes higher, finishes higher, finishes higher, finishes higher. Now it starts to come down. And look at today. Big move down intraday. If you decided to buy, here was another situation where you got more than 1%. from the low. Now, maybe you wait until the downtrend breaks. Maybe you buy it over in here. Maybe you make $1 on it instead of $1.70. I don't know. But my point is, these are trades that if you like the short-term trade, maybe scalp a little bit on a solid stock like Apple that's been uptrending, it's been giving you plenty of opportunities to do that. I mean, even some of these days where it goes up and then it drifts for a while and then it rallies into the close. Here, go up in the morning, we move back down throughout the middle of the day, then we rally into the close. I mean, right here, we're trading near the bottom of that candle for the day. And then by the end of the day, we're back up at the high. AD line keeps going up. So just keep that in mind. I wanted to show you another one on this list. This is Fortinet. Look at this AD line. So it started moving up back here, even when we had this pullback in late December and struggled first half of January, AD line was holding up. Then once we broke above the 20 and the 20 breaks above the 50, look at the AD line taking off. So what does that mean? Again, short-term, maybe midday weakness. If we were to go down tomorrow and get back down to that 20-day moving average, say by noon, I would think about buying it in the afternoon based on its strong AD line. Figuring, I mean, there aren't a whole lot of filled candles. I mean, when you look at this from the low back in January, second week of January, you got a lot more hollow candles and reversals with tails to the downside than you do big red candles. There's one, here's one here, here's one here, maybe one or two of these. I mean, maybe 3 or 4 in the last 3 months. So if you get early weakness in the morning, maybe until noon, 1 o'clock, that could be a great opportunity into the close on a stock like Fortinet. So just keep that in mind. All right, I want to move on. I want to move on to earnings spotlight. And I wanted to just take a look at some upcoming big earnings reports. So earnings season, in my view, kicks off on the 14th, which is a week from Friday. That's when we're going to see JPMorgan come out. I kind of use JPMorgan as now the kind of the coin toss or whatever you want to call it that kind of kicks off the earnings season. And on the 14th, there's about, I don't know, 5, 6 names, pretty big names that are going to be reporting. So I thought what I would do is just quickly go through and give you my take on what I'm seeing in terms of their relative strength. Because when I'm looking at whether or not I think a company is going to have a good report or a bad report, a lot of times I like to see how they're trading in the couple of months, few months leading up to earnings. So UnitedHealth Group has been rolling here of late, but they report a week from Friday. And if you look at the relative strength. So the overall group's been going down. UNH has been going slightly down, which means it's actually been outperforming. And now when the group finally starts to get some strength, look at what UNH is doing. This could be a pre-earnings run. We could get a pretty big number. I could see the stock making a run back toward 550. I would say potentially within the next few weeks to a month. I mean, that'd be an 8% move in a stock that normally doesn't move that far that fast. But that's what this chart's telling me. With the relative strength, with the group starting to get money into it, the volume picking up, and you can see finally we're getting this AD line to turn back to the upside. The next stock I wanted to look at was JPMorgan. So JPMorgan AD line's been strong. Price action was strong, but it went down because of the banking crisis. Look at the relative strength on JPMorgan. I will tell you what, if JPMorgan misses or disappoints with their earnings and they're one of the leaders, you better watch out for these banks with their earnings reports coming up. JPMorgan is one of the leaders. We need to see a good report out of JPMorgan. If we don't, then we got some serious issues. JPMorgan's been going down along with the bank index, but it hasn't been going down as much as the bank index. It's been a relative leader. So when a lot of the stocks were getting absolutely clobbered in the banking area back first, second week of March, yes, JPMorgan took a hit, but on a relative basis, it was nothing compared to what some of the other banks were taking to the downside. Now, technically, I'd like to see JPMorgan get back through the 20-day. Until that happens, I'd be a little careful. Next one, how about Wells Fargo? How's that one look in the banking space? Well, much bigger drop. On a relative basis, it did go up to a 52-week high, but it's come back down. This one, and it's not at the 20-day like JPMorgan. It's a little bit below it. So this one doesn't look quite as good to me going in. Citigroup, I'll do two more of these banks. Citigroup, AD line looks not so bad. We pulled back, starting to strengthen though. So a lot of this, look at that hammer right there. That gives you a big boost in your AD line because you get increasing volume, get a reversal, close on the high, and then move back to the upside. Relative strength looks good. So I actually like Citi. I think Citi is up there with JPMorgan in terms of the banking group needing those two to come through. The last one I wanted to give you was PNC. PNC has been moving down. It's back down near its low. Relative strength, not very good. So this one relative to JPMorgan and Citigroup may not come through with quite the report that we see from Citigroup and JPMorgan. That's the way I would evaluate those. All right, let's move on to the three you must see, and then we'll wrap up the show. First is Progressive. Wanted to show you Progressive. It's been in this uptrend. Nice little cup, a little bit of a handle. Just broke out today. Let's see if we can follow through. But if we don't, we fail. Watch that rising 20-day moving average. I do think PGR goes higher, though. LNT. So this is Alliant Energy. Downtrend line. Connect those downtrends or the highs, which are in a downtrend. Look at the breakout. I like that. I think we could be starting with bouncing off the 20-day. Looks like an uptrend potentially. So LNT looks interesting to me. And then NET, which is Cloudflare. It's pulled back, but I'm seeing a pullback off an uptrend. Left shoulder, neckline, head, neckline, right shoulder, which is almost equal with the left shoulder. Need to see a reversal here on Cloudflare. Anyway, that's it for me. I appreciate you tuning in. Go over to Earnings Beats. Make sure you get registered for the event, and I hope to see you there. In the meantime, have a great rest of your week and weekend. I'll be back on Monday for your next Trading Places Live over at earningsbeats.com. Happy trading, everybody.